So we've looked at the market and how that kind of works, and now we're going to look at the next section. Okay, what shares to invest in? It's one of those questions where there's no really right or wrong answer, but there's really good things to look at about what to do when you take into account buying shares. A newspaper share list, which is published every day in the newspaper, gives you a lot of information. There's also lots of stuff on the internet, but the share list is something that's really easy to look at and gives you some really good ideas about what's going on. Let's have a look at this one. This comes out of the Advertiser. This is just a share trading from the industrials. So this is like banking and all those kind of things. You can see there's a whole lot of columns here, and generally this is what is floating around. You've got the year, high and low. Okay, this is the highest price that these shares have traded at that year, and the lowest price that they've traded at during the year. Okay, now the year is the financial year, so that's what's in here. So let's have a look at ABC Learn. Their highest price is $14.10. Okay, so that's one that's in cents, and their lowest price is $1.90. So that's pretty cool. It's gone really well. The next column is stock, which tells you the name of the company. Once again, we've got ABC Learn. Now these have all got a bit of a, like you can say that's ANZ Bank and those kind of things, but there's a code that the share market uses to register these, and sometimes they're different from the names. You've got to search for those code. So this stock tells us the name. The close move price tells us the price that it closed at on that day and how far it moved from the day before. So what it closed at and where it's gone from the day before. So this is $13.50, which is down 5 from the day before. So the day before this, it must have been $13.55, okay, because it's gone down 5. Now, remembering that the newspaper that you've got shows you the shares from the day before. So if this is on Friday, this is actually Thursday's shares, and if it's Thursday's shares and it's down 5, it means on Wednesday, which is one day before that, it was $13.55. So always remember that it goes backwards in time. The buy price and the sell price. The next column is the buy and sell. Now this is what people are willing to pay for them to buy them, and this is what people are willing to sell them for. So for ABC Learning here, people are willing to pay $13.45. People want to sell them at $13.50. Okay, so you might put a buy offer in at $13.45, and there might be no one floating around offering you that price. It might be $13.50. If someone drops their price to $13.45, your trade will go through automatically. Or the other way around, if you raise your price to $13.50, your trade will go through automatically. The next one, volume in hundreds. So it means 1,500 shares are traded on that day. So whatever is in this column, you times it by 100. Sales high and low is for that day. The higher sale for that day, the lower sale for that day. Okay, so the higher sale is $13.54, the lower sale is $13.45. The yield is the return you get in the dividend compared to the price of the shares. So you're getting 1.04% back on these shares at this time. But if you can look at it, you might think, well, that's not very much. Look at this one here. This is 6.99. That's a really good return, considering bank interest rates are only about 5%. So 1.04, you might be thinking that's a bit kind of weak. Why would I invest? The thing is, you look over here. They've gone up from $1.19 to $14.10 in a year. So really, if you've invested in them, your capital gain is growing so well that this 1.04%, it doesn't really matter too much. On this page, what you need to do is you need to fill in a definition for year high low, definition for stock, close move, buy sell, volume, sales high low, and yield. What kind of shares to buy? Well, to make an informed decision, there's heaps and heaps of things that you can do to find out. Look at media releases, see what's going on in the market. Talk to financial advisors, financial planners and stockbrokers. Read the newspapers, the financial pages. The Australian has some really good information in there. Look at the types of shares that you can buy in. There's different types floating around, so have a look at those, and we'll talk about them a bit later. Read the prospectus to see what the company does. Do some research on the website. Look at the yield, if you get a good return for your money. Look at the company history. There can be different kind of formulas you could look at. You know, if they're going up really well and they start rising by 5%, they might be a good one to look at. Read the annual reports. look at charts and graphs. It looks at the volumes of shares that are traded. So if a lot of people are trading them, it could mean that either people are wanting to sell them or people are wanting to keep them. So you need to have a look at those ones as well. Look at the high-low prices for the year. And people say, oh, well, I will invest in blue chip shares. Blue chip shares are shares that give you a good return over time. They're very stable. So banks and things like that tend to be blue chip shares. There are seasonal shares. These mean these ones that fluctuate up and down during the year. And certain market forces make these go up and down, and sometimes people will buy them. It also can be called cyclical shares. There's also long-term and short-term investments. So you might want to look at, okay, if I'm going for the long term, that's investing money to 5, 10, 15 years. Short term might be anything from a couple of weeks to 6 months. You also want to look at the business operations of the company to see what they're into. The amount of money that you've got available to be able to spend, realizing that you've got to be prepared for it to go down. And the other thing to look at is possibly looking at ethical trading, which means looking at what the companies are into and supporting the companies that back your beliefs. When to trade. After a rights issue or a bonus issue is released, and we'll talk about what they are a bit later, the price tends to drop. Or even after a dividend is released, the price tends to drop. So that's a good time to buy because the shares go down a bit. Have a look at the graphs, see what's going on. You'll find that after a drop, sometimes there is often a peak up, and you might want to buy on a falling market, waiting for it to return. You should calculate the break-even price. This is the price that the shares have to get to so you get your money back. If you know what that is, and that's within a close reach of what your buying price is, then they may be a good investment. If they're very expensive shares, like those BHP ones that were $75 earlier on, they have to rise a lot of money until you break even. Look at averages and moving averages to see what the average price is, and look at trends over a time. We're going to talk about that a bit later on with moving averages. Pre-dividend and post-dividend is very similar to bonus issues and rights issues. Pre-dividend, what happens is the price tends to go up because people want to have them before this date. And then once they go post-dividend, well, people aren't going to get their money back, so the price drops a bit. Look at the general trends. There's normally there can be crashes, which is a risk. And you often have to look at for the cycles as well. Some people often say trade only money that you're willing to lose, which means that don't put all your eggs in one basket and think that this is the way that you're going to retire on forever. The share market can give you a good income and can give you good capital return, but you need to have it for a long term and be prepared to wait. And I talked about ethical trading before. The types of shares, there's a couple of types of shares that you may actually be able to invest in, and we're just going to quickly run through them. Ordinary shares, these are the ones that are the most common, and this is what most people buy. Okay, they are often quite cheap. They are floated with the majority of the shares when they first come out. They deliver dividends. There's good potential for capital gain, but the dividends are paid after preference shareholders. So preference shareholders get preference, so they get paid first. Dividends to ordinary shareholders come second. You have voting rights, so you can actually vote in the way the company goes. And most investors opt for a kind of a blend of a portfolio that has majority of ordinary shares in it and some preference shares. So you might be thinking, well, what's a preference share? Well, preference shares are not as common. They're a bit more expensive, and there's only a certain percentage of them in that kind of makeup of shares when the company's first floated. They have a fixed dividend rate, which means that you'll always get the same amount back per share every year. Okay, and that's pretty cool because you can actually plan ahead and be guaranteed of an income. There's potential for capital gain here. The dividends get paid before the ordinary shareholders. Sometimes you have limited voting rights, and some investors will have preference shares in there as well, so they get a regular, predictable dividend. But if they make lots and lots of money, then the ordinary shareholders could get a bigger dividend than preference shareholders. So that's a bit of a risk you have. So preference shares are good to have in a portfolio because it gives you a balance and it gives you a regular income, whereas ordinary shares can give you more income or more return than preference shares. Rights issues. If a company wants to raise some more money after the company's been floated, they can't just go and just release more shares because that's not quite, you can't do that. But if there's a rights issue, they release shares and people who have already got shares can actually take up the rights. So it might be something like a 1-for-4 rights issue, which means for every 4 shares you have, you can buy one more. they're at a discounted price and they go straight to you without going through a broker. And that means the money goes straight to the company. Okay, so they're quite a good little thing. So some people will take up rights issues because they can actually have them, pay the company some money and increase the number of shares in their portfolio. Bonus issues work the same, but they're issued free. Okay, so the money is not generated into the company as much or at all because they don't pay for them, but they get more shares on the market. Terminology. When you read a question in this course, you're going to see questions like the ones below, and I want to tell you what each of the little bits mean. First bit, preference shares will come down with 500,000, $2, 5% preference shares. Okay. What this means is that's the number of shares that are floating around. This is the par value. The par value is how much they were released at when the shares were floated. How much they were released at when the shares are floated. They can be trading above this or below this, but this is the par value. And this one here, the 5% is the dividend rate. So what that means is you will always get 5% of $2 for each share you have. Okay, for all the time. It won't change because these are preference shares. Okay, so 500,000 number of shares, $2 par value, 5% is the dividend rate. For ordinary shares, you have 500,000, 50-cent ordinary shares. Notice that you don't have this rate here because there's no fixed dividend rate for ordinary shares. So once again, the 500,000 is the number of shares. 50 cents is the par value, which is the value they were floated at, and they can be trading higher or lower than that. So this is the terminology that you'll see in most questions to do with shares. Alright, that's the last bit of this one. That was just a whole lot of information which hopefully you can note down on your PowerPoint as well.